Hello and welcome to the Global Forecast from the Economist Intelligence Unit. I'm Tony McMahon, and as you can see, we've decided to bring the programme out into the sun. But let's find out if the prospects for the global economy are as bright as the weather. Robert, a double dip scenario. Are we going to see any of the developed economies slip into recession?
Well, the markets are looking pretty sickly at the moment and suggesting that the global economy is heading for, I suppose, a period of slow growth. Some of the commodities are also looking pretty off colour, I suppose. Coal, iron ore, even the great Baltic Dry Index, which now we all know about, thanks to the crisis, which measures global shipping, that's looking pretty off colour as well. So there are quite a few indicators suggesting that the world is in for a period of slow growth. I would argue that we shouldn't get overexercised about this. If you bear in mind that we've had incredible stimulus in recent months, the inventory cycle is now turning, the stimulus is now coming to an end. Of course, the really strong growth that you saw in the first half of this year, of course that's going to come off, and of course you're going to get slower growth. That said, I don't want to sort of underplay the seriousness of what's going on either. We look at the United States, for example, where a lot of the data, again, are pretty mixed now, and I suppose the most worrying bit of that mixed data is the employment market. Private sector is really not creating jobs as it should be at this stage in the cycle. The government, particularly with the census now reaching its end, that's going to be shedding workers as well. Of course, if you have people leaving the workforce, discouraged workers going up, long-term unemployment going up, all this is bad for consumer sentiment. You see this already in retail sales, which are falling, in the housing market, which looks pretty sickly as well. So there are some signs, I suppose some signs to be worried, but our core forecast has for a long time been that growth globally will slow in the second half of this year. So this slowdown is something that we are expecting.
So the current austerity drive in Europe may not be so damaging as some believe it will be to growth prospects.
Well, clearly, if you're cutting spending and raising taxes at a time of a weak economy, then fiscal austerity is not going to be good for growth. But I think it's important to separate the short term and the long term. Over the short term, clearly there's going to be some negative impact. But if things go well, this is going to create, I suppose, structural reforms, more productive allocation of spending, will boost growth over the long term. However, there's a couple of, I suppose, danger points here, one of which is the stress tests that are going to be announced for the European banks very shortly. And the other one is the European stabilisation mechanism, the bailout package for the Eurozone. Now, if neither of these really gains traction in terms of convincing the markets that they're able to backstop everything, then you could get another round of volatility, which would of course be bad for consumer sentiment again, bad for banks, particularly if counterparty risk remains elevated, and this would then feed back in a negative feedback loop back into the broader economies, which, as we've just talked about, are now facing austerity. So there are some issues there to be worried about.
Turning to Asia, how do you expect the Chinese currency to be valued against the dollar going forward?
Well, the Chinese have obviously changed the way that they're managing the renminbi for a couple of weeks ago to great fanfare. Actually, it meant less than the headline suggested. We've assumed that really, despite this change, there isn't really going to be much of a change in the way that the Chinese, in the gradualist approach that the Chinese authorities have to the renminbi. So we're expecting a nominal appreciation of about 3% a year over the next 5 years, which takes the renminbi to about an average of about 6 to the dollar by 2014. So very incrementalist. One of the reasons why they're going to take this very gradual approach, of course, is they're looking at what happened to Japan in the middle of the 1990s, when the yen lurched up against the dollar for all sorts of reasons, and that was seen as one of the triggers for Japan's deflation. So they're going to be very, very gradualist about it. They'll do what's best for China, no matter how loudly the trading partners shout.
Japan's seen respectable export-led growth, but do you think that that can continue?
Well, you say respectable, and it was sizzling in the first quarter of this year, about 35% year on year, which is pretty good. As all things in Asia and pretty much globally now, As with all these things, it's all dependent on China. Japan is very close to China, has really benefited from the, I suppose, spillover effects of the Chinese fiscal and monetary stimulus. Unfortunately for Japan, however, China is slowing, and because of this slowdown, Japan will also slow. Japan, like everywhere else, is seeing an ebbing of the impact from fiscal stimulus. This, coupled with the entrenched deflation, which of course hits private consumption, will see Japan really slowing quite substantially in the second half of this year and into next year. So this year overall Japan's going to grow by about 3%, the best performance since 1991, so pretty good overall, but next year we're expecting much more of a kind of traditional Japanese performance of just over 1% or so.
Thanks, Robert. Well, we're going back indoors now, but join us again next month for more insights on the world economy with the global forecasts. Until then, thanks and goodbye.